Hello, and hope you're doing well. This is Ahura, and we'll be with you to see the US personal income and spending data and market reactions. So, as always, first let's check the data and see what we have as a data, and then we can go forward and check the market reactions. Core PC price index and PC price index both increased by 0.1% monthly basis. I mean, the core PC price index, it was both of them in line with expectations. However, the core PC price index was unchanged from 0.1% increase of the previous months, but the headline personal inflation, personal consumption inflation or personal PC price index the headline on the monthly scale increased by 0.1%, which is slightly above the flat number that we had previous month in March. However, on the annual scale, the core PC price index lowered to 2.5%, in line with expectations from 2.7%, but still, that's an amazing number. I mean, the core PC price index finally lowered under 2.7% and down by 0.2%. The headline inflation, on the other hand, which was expected to slow down to 2.2% from 2.3% printed in the March, slowed more to 2.1%. That means that the inflation is under control. If we look the data until this, I mean, we don't go forward and check dollars. If we look the data just with the inflation numbers, that can tell us that the central banks was very sexist, or Federal Reserve was very sexist to control the inflation, and we can see the headline inflation is already around 2.1%, so close to Federal Reserve target inflation. But on the other hand, if we go forward and check the other data, such as personal income, the income increased by 0.8%. That was amazing number, towards almost 3 times more than 0.3% expectations. Even the previous numbers, which was around 0.4% also, revised up to 0.7%. That means that the US that American citizen or the Americans, they gain much more than expected, 3 times almost more than expected. So that's on the other hand, when we see the spending increased only by 0.2%. Spending increased only 0.2%. Even the real spending adjusted with the inflation also increased by 0.1%. That means that the people, while they have much more income, they are spending less, but still they have income. So it means that if they had a dip, the dip's already lowered, so we have less dips. On the other hand, we have more savings. We have more financial confidence, which means that in coming months, the demand can increase and the people can expect more things to buy, which means that when demand increasing, it's increased the risk of higher inflation. So these numbers, the inflation numbers, while they can be somehow a good number, I don't doubt on that, but at the same time, the spendings, they're so tricky. These data is so tricky. If you look these data as a financial markets analyst, or even thought if you're the Fed member and want to see these data as okay, so let's say that you want to make a decision based on these data. As a decision maker, you can say that these numbers, they are so tricky, man. We cannot decide based on these numbers. Why? Because yeah, we can say the inflation is lower, but with the higher income, there is a risk of more spending, more demand in the next months, which means that increasing again, we can expect the higher demand, which can drive the prices higher. Look at the other data we have here. We have a good trade balance. There is still at that yesterday also we had the GDP numbers. If you remember, the GDP lowered by 0.2% in the first quarter. It means that in January, February, and March. These numbers are covered for the April, so just like 1 month later. So many companies and the people, they started buying tariffs, which means that before they have been expecting that the tariffs can increase the prices. So they increase their demand. So it can increase the demand. As you remember, we had a much higher retail sales. The personal spending also increased by 0.7% previous month. So people they spend much more money to buy the things before the price got higher. So that's why the demand increased previous month. Previous month the spending increased. Previous month the import also increased. So the higher imports drive the good trade balance to minus $162.25 billion, which reversed this month in April. And now we have good trade balance only minus $87.62 billion. Almost, we can say almost twice less. So almost twice less imports we had in April compared with the March, which means GDP in the second quarter can fastly can increase so fast and can increase so good. So that means still looking at these numbers means that the uncertainty in the market increased. Look at this number here. VIX now is at increased by 2.45%. At night almost 20. So that data, what this data says? This data says that the market risk is higher, even though if the stock markets had somehow. If you look at the futures, actually, the futures they had a negative reactions. Let's check on we'll check the reaction on the chart before going towards checking the charts. I say that here, if you look at the CME group FedWatch tools, you can see that we have more than almost 95% expectations for holding the current rates in the next month, in the next meeting, which will be in 18 days. So the markets still have a doubts, and there's uncertainties high. When there is uncertainties high, the safe havens have a demand. So we have a more demand for the safe havens. Let's go to the chart. Let's check the chart and see what we have in the charts and how the market can react to these numbers. So the demand increasing, so the safe haven demand increasing, so the uncertainty increasing, which means these numbers can be positive for US dollar. Even though at least we can say that even if they are not a positive, they cannot be the negative. So, like, I will say something. If we had income, if we had inflation or at 2.1%, but the income around 0.3%, as market was expecting. Then with these numbers, with 2.1% personal inflation, we could see the US dollar index under 99 mark, around 98, around something around 98. But now we have the tricky data here. We have the income increasing by 0.8%, which means 3 times more. That can increase the market risk. So that's why we can say that the market now pricing much more on the uncertainty in America, so the policymakers can say that, okay, we have no idea what the hell is going to happen, so let's hold the prices, let's hold the rates at the current level and wait and see what's going to happen. That's why that cannot be the negative for US dollar, even though it can be somehow the positive as well. That increased the uncertainty in the market. The dollar index, the gold price can have a positive reaction for it because we have a negative reaction in the stock markets. These numbers are the negative for the stock markets. The uncertainty increasing, the higher uncertainty, more pressure on the stock markets, that can increase the gold demand. So I want that to just avoid this initial reaction of increasing and falling. But these numbers can hold the gold price around 3,200 US dollar, like the side movement with the uptrend tendency. That can be our expectation for the gold price after these numbers. So for S&P 500, for Dow Jones, Nasdaq, and other stocks, other indices also, generally we are negative. We can expect more pressure. Also, we can add this news that we recently had a news that the U.S. and China trade talks is paused for now, settled or somehow. We have to wait and see the more news, and then we can expect, then we can decide what exactly happened there. But generally, what we can see here, these numbers, they are not a positive number for the Federal Reserve to say that, okay, they can make a decision and they can rely on their policies. So that's why it can be generally it can be negative for the stock markets. It can be negative for S&P 500, for Dow Jones, for Nasdaq, but at the same time, it can be positive for gold. It can be positive for US dollar index. It can be also the negative for it can be negative for the cryptocurrencies as well, especially for the Bitcoin, but not that much hard, but it can beat the Bitcoin price as well. Yep, that was generally what happened in the market, the data and the market reactions. Also, generally the market expectations with these data after these data. If you had another question, don't forget to write in the comment section. I will try to get back to you as soon as I can. Have a good time. Bye bye.